Well, hello there. I'm Gemini.
Welcome, everyone. Look, let's be honest, the Canadian tax system can feel, well, a little overwhelming, right? That's exactly why we're here. Today, we're going to break down all the essential 2025 federal tax rates and credits for you. The whole point is to cut through the jargon and give you knowledge you can actually use when it's time to file.
So here's our game plan. We're going to walk through this using what I like to call a tax life cycle journey. It just makes sense, right? We'll start with the basics, then move on to things that pop up as life happens. Family, home, career, health, all the way to investing and giving back.
Okay, let's dive right in. We're starting with the absolute foundation for everyone. These are the two building blocks of your entire tax return.
Now, this table is super important because it shows how Canada's progressive tax system works. And there's a huge misconception about this. You don't just pay one flat rate on everything you earn. The best way to think about it is like filling up buckets. Your first $57,000 or so get taxed at 15%. Then, once that bucket is full, any money you earn on top of that spills into the next bucket, which gets taxed at 20.5%, and so on. So it's only the money in that higher bucket that gets the higher rate. That's a really key thing to remember.
So, what's this basic personal amount, or BPA? Honestly, it's your personal tax-free zone. Every single Canadian gets this. It's the base amount of income you can earn before you have to pay any federal tax. It's a huge deal. But, and this is important, how much you can actually claim depends on your income.
And here's how that works. It's basically a three-tiered system. So if your income is under about 178 grand, you get to claim the full maximum BPA. Awesome. If you're a really high earner, over that $253,000 mark, you claim a slightly lower base amount. And if you're somewhere in between, well, the BPA amount you can claim gradually slides down. Now here's a little pro tip for you. If you find your income is just a little bit over that first threshold, a smart RSSP contribution could actually knock your net income down enough to let you claim that full, higher BPA. Something to think about.
Okay, so we've got the basics down. Now let's get into the stuff that supports you through some of life's biggest milestones. Family, buying a home, caregiving. This is where the tax system really tries to help out.
Okay, this is a really key comparison. On the surface, these two credits look almost identical, right? They're both for supporting a loved one who has a low income. One's for your spouse or partner, the other is for an eligible dependent, like a child or even an elderly parent living with you. The amount you can claim is based on your own BPA. But here's the catch, and it's a big one. You can generally only claim one or the other. You can't double dip. So if you're claiming the spousal credit, you can't also claim the dependent credit.
Next up, we have the Canada Caregiver Credit, and this one is so important. It provides some really targeted relief for folks who are supporting a family member with a physical or mental infirmity. You can see there are two main amounts, one for a child under 18 and a much bigger one for a dependent who's 18 or older. Just keep in mind, for that adult-dependent credit, there is an income test. The credit starts to get reduced if their own net income goes above about $20,000.
All right, homeowners, listen up. Or future homeowners. These are three really significant credits designed to help you out. First, you've got the first-time home buyer's credit. It's a helping hand for getting into the market. Then there's the home accessibility credit. This is huge if you're doing renovations to make your home safer or more accessible for a senior or someone with a disability. And finally, the multi-generational home renovation tax credit. This one is pretty amazing. It helps you build something like a secondary suite for a senior or disabled relative to live with you.
Okay, moving on. Let's talk about credits for your career and your own personal development. Work, school, and training.
So have you ever wondered why, if you're self-employed, you seem to be paying double the CPP? Well, there's a reason for that. As an employee, you pay your share, and your employer pays a matching amount. But when you're self-employed, guess what? You're both. You're the employee and the employer, so you have to cover both halves. It's a big chunk of change, for sure. But here's the silver lining. You also get a much larger tax deduction because you get to deduct that employer portion from your income.
Now, this number might not look like much at first glance, but the Canada Employment Credit is a big deal because pretty much every employee gets to claim it. It's meant to help with all those little work-related expenses, things your employer doesn't reimburse you for. The maximum it's based on for 2025 is this number right here, $1,471.
For all the lifelong learners out there, this is for you. The tax system really does offer several ways to help offset the costs of education and upgrading your skills. You've got the big one, the tuition credit. Then there's the student loan interest credit. And I really like this one, the candidate training credit. You basically bank $250 a year to use on future training costs. And don't forget about the transfer of tuition. This is so helpful for families. A student can transfer up to $5,000 of their unused tuition credits to a parent or grandparent.
All right, let's shift gears now to a really critical area: support for medical expenses and for individuals with disabilities.
Okay, so how does the medical expense credit actually work? Well, it's designed to help when you've had some pretty significant out-of-pocket medical costs during the year. Here's the process. First, you add up all your eligible expenses. Then, and this is the key part, you have to figure out your threshold. It's either a set amount or 3% of your net income, whichever is lower. You only get to claim the expenses that are above that threshold. Think of it as your deductible. Once you have that amount, the credit is 15% of that number.
The disability credits are so important. They're there to provide some much-needed tax relief for the extra costs that can come with living with a severe and prolonged disability. As you can see, there's a main credit amount and then an extra supplement if it's for a child under 18. And what's absolutely crucial here is that these credits are transferable. If the person with the disability can't use the full credit themselves, it can be passed to a supporting person, like a parent, to make sure that financial help isn't lost.
Okay, everyone, I want you to really focus on that word, refundable. This is a total game changer. Most of the credits we've talked about are non-refundable, meaning they can wipe out the tax you owe, but they can't give you money back. A refundable credit is different. This is money you can get back in cash, even if you don't owe a single penny in tax. It's a real refund. And this specific supplement is designed to help lower-income workers who are also dealing with high medical expenses.
All right, we're on the home stretch. Finally, let's look at credits for giving back and for investing in your future. We're talking donations, pensions, and dividends.
For anyone who's retired or getting close, this is a key credit to know about. It lets you claim a credit on the first $2,000 of your eligible pension income. It's a simple, direct way to reduce the tax hit on that income.
The charitable donations credit is really interesting because it's tiered to give you a bigger incentive to give more. So for the first $200 you donate, you get a 15% credit. But for every single dollar you donate above $200, the credit rate jumps way up to 29%. And for the highest earners, it can even match the top tax rate. The takeaway here is pretty clear. The tax system really wants to reward generosity. When it comes to dividends from investments, it's not quite as simple as you might think. Not all dividends are created equal, at least when it comes to taxes. You'll see the term gross up. All that really means is the dividend amount is increased on paper to reflect the tax the company already paid. Then you get a tax credit to balance it all out. The main thing you need to know is what you see here. Eligible dividends, usually from big public companies, are treated more favorably than non-eligible dividends from smaller private companies. It's just a different calculation. And this is just a little snapshot to show you how varied and specific the tax code can get. There are credits for everything from adoption expenses to recognizing volunteer firefighters and search and rescue crews, and even for making small political donations. It's a great reminder that it's always worth looking into your own specific life situation to see what might apply to you.
So, there you have it. We have covered a ton of ground. And really, the whole goal here is to empower you with this knowledge. Because now that you know about these credits, you can start thinking about how to optimize your own tax return for 2025. Hopefully, you're feeling a bit more confident and ready for your next tax season. Thanks so much for joining me.